Okay, let's dive into a real mystery happening in the markets right now. On one hand, you have the spectacular, super hyped world of AI technology. And on the other, you have gold, the oldest, most reliable safe haven asset on the planet. And right now, somehow, they are both soaring to record highs at the exact same time. This is not supposed to happen. So let's try to figure out what this paradox is really telling us.
So, that's the big question, isn't it? Why? It's like the market's greed pedal and its fear brake are being slammed to the floor at the same time. When an asset that represents pure speculative hope and an asset that represents deep economic anxiety start telling the same story, it usually means something big is shifting right under our feet. In this explainer, we're going to unpack this whole thing.
All right, let's start with the story everyone knows, the one that's been impossible to ignore, the absolute frenzy around artificial intelligence. I mean, it's been the dominant theme for a while now, right? It's powering this massive rally in tech stocks and just sucking up all the oxygen in the room.
But here's the catch with this AI boom. It is incredibly concentrated. So while it might feel like the whole market is lifting off, the reality is that a massive chunk of the gains, we're talking nearly 70% of the Nasdaq's entire performance, is coming from just a handful of giant companies. This isn't a broad rally, it's a few titans pulling everyone else up. This is the greed side of the market in full swing.
But here's where the story gets really weird. At the exact same time that tech stocks are flying high on pure optimism, gold, the ultimate something's wrong asset, is also smashing records. I mean, these are two completely different narratives unfolding at once.
And you can see the conflict right here. On one side, you have the AI rocket ship, just fueled by hype and incredible earnings. On the other side, you have this fortress of gold, being built up by people worried about recession, by central banks hedging their bets, and this whole global trend of moving away from the US dollar. These are, fundamentally opposite instincts.
So what happens when two totally opposing forces start moving in the same direction? Well, history tells us that this kind of alliance, it never lasts. It's a really unstable situation, and sooner or later, something's got to give. This number says it all. A correlation of 0.78. That just means that for the last 3 months, tech stocks and gold have been moving almost perfectly in lockstep. This is a massive statistical anomaly. It's the highest it's been since late 2022. These two are just not supposed to be this in sync. This isn't the first time we've seen a pattern like this. It's almost like a historical warning sign. Just think back to the dot-com bubble in the late 90s. What did we see? This massive, speculative tech boom, which was followed almost immediately by a historic rally in gold as soon as that bubble burst.
And the parallels just keep stacking up. This is the Shiller PE ratio, which is basically a long-term gut check on whether the stock market is cheap or expensive. Right now, it's getting close to 40. The last time it was this high was right at the absolute peak of the dot-com bubble. It's a pretty clear signal that valuations are getting seriously stretched.
So, if the stock market is flashing these kinds of warning signs, where is the really smart money going? The biggest clue isn't in the day-to-day stock charts. It's in these massive, almost tectonic shifts that are happening in global capital.
Okay, let's just try to get our heads around this number for a second. The total value of all the gold ever mined in the history of the world has now hit 35 times $1 trillion. To give you some perspective, that's more than the entire GDP of the United States and China combined. It is an absolutely mind-boggling amount of money. Now let's add in its less flashy sibling, silver. That's another $6 trillion on top. So between just gold and silver, we are now looking at a $41 trillion market for precious metals.
And here is the punchline. That $41 trillion is 9 times the market cap of Nvidia, the poster child for the entire AI revolution. So while everybody is talking about AI, the actual center of gravity for capital is shifting hard into these physical assets.
So who is moving all this money? I mean, this isn't just retail investors hedging their 401ks. This massive flow of capital is being driven by the biggest financial institutions on the planet, central banks, who are very deliberately diversifying their reserves.
And you can see that shift happening right here. Over the last decade, the US dollar slice of the global reserves pie has shrunk, big time, from 58% down to 40%. And where did that money go? A huge chunk of it went straight into physical gold, which saw its share climb from 16% to 28%. This is that de-dollarization trend you hear about, and it's happening in real time.
Okay, so we've got a market that's torn between wild greed and deep-seated fear. And we have this massive global capital shift happening in the background. So what does this actually mean for you?
Let's just break it down.
Nvidia is the classic speculative growth play. It's super volatile, it's driven by hype and future promises. Gold is the polar opposite. It's a low volatility, safe haven that people run to when there's risk in the air. But what's really fascinating is that gold actually has a physical role in AI. It's not the brain like Nvidia's chips, but it's the nerves, the high-speed connectors inside servers that need gold because it's so reliable.
I think this quote from Macquarie analysts just perfectly sums up where we are. Optimists buy tech, pessimists buy gold, hedgers buy both. It really captures the three different mindsets that are all clashing in the market at the same time.
So what does it really mean to be a hedger? It's actually pretty simple. It just means you're acknowledging that both massive opportunity and significant risk exist at the same time. You're basically buying an insurance policy in case your main bet goes south.
So here's a simple framework to think about all of this. First, just recognize this tension that's playing out in the market. Second, understand this is bigger than just stocks. It's about a global currency shift. And third, that leads you to ask, what does macro insurance actually look like for my own portfolio? So the crucial point is this. The data clearly shows that the world's biggest, most informed financial players, the central banks, are quietly hedging. They're not selling their growth assets, but they are aggressively buying gold as insurance, which leaves one pretty important question. Are you?
And that really brings us to the final question. The market is telling two completely different stories right now. The story of a futuristic AI boom and the story of a classic old-school gold rush. You don't necessarily have to choose one over the other, but you do have to decide which one you think is going to define what happens next.